Over the past several years, when people have been looking to take out mortgages, most people have predominantly looked to take out fixed rate mortgages. Due to the market conditions currently, fixed rates aren't always necessarily the lowest rate option for people. So in this video, we're going to look at all the different product types available when taking out a mortgage. When you're looking to take out a mortgage, it's important to understand that everybody's situation is different and what's right for somebody isn't necessarily right for somebody else. When you're looking to take out a mortgage, it's really important that you speak to a mortgage broker, as a mortgage broker are able to explain all the different mortgage types that are available to you. So there are 3 different types of mortgage products that are available. The first one is a fixed rate mortgage. The second is a tracker mortgage, and the third is a variable rate mortgage. Not every lender offers all different types of mortgages. So when you are speaking to either a mortgage broker or your bank, make sure that they are giving you a varied approach to your mortgage. So now let's look at all of the different mortgage types individually. So the first mortgage that we're going to look at is a fixed rate mortgage. A fixed rate mortgage is where your monthly payments are fixed for a set period of time. So when you're looking at a mortgage product, the fixed rate can normally be set out for either a 2-year period, 3-year period, 5-year period. There are also some lenders that will look at 10 years and even some that will look at fixed rates for the full term of your mortgage. Not every lender will offer all of those different types, which again is a good reason to speak to a mortgage broker, as they will be able to look at all of the different lenders available to use. A fixed rate mortgage is really helpful when it comes to budgeting. If you know exactly what you're going to be paying for a set fixed amount of time, you can then make sure that you've got adequate funds available to cover your mortgage and other bills. So for example, if you take out a 2-year fixed rate mortgage, you know for the next 2 years exactly what you're going to be paying each month on your mortgage and can then work out what monies you need to transfer over to make sure that mortgage payment is covered. The other good thing with a fixed rate deal is that interest rate is fixed. So what that means is if interest rates were to rise over the term of that fixed rate deal, your mortgage payment stays exactly the same. So at the moment, interest rates are on the rise. So a fixed rate deal for some people may be a really important product, because what that means is whilst those interest rates are rising, they know themselves that they are going to pay exactly the same each month. One drawback of a fixed rate deal is if those interest rates were to reduce, then unfortunately your payments do stay the same. The other drawback of a fixed rate deal is most fixed rate deals do come with early repayment charges if you wanted to exit the deal early. So let's take an example. If you took a fixed rate deal for 5 years and you wanted to pay that deal off within that 5-year period, there may be early repayment charges. Now, those charges can be as high as up to 5% of the mortgage balance if you went on a 5-year deal. So typically, those fees do drop during the term of the fixed rate deal, but again, each lender is different. So it's important that you understand the charges associated with paying off that mortgage early before you enter into the agreement. Also with fixed rate deals, if you look at longer term fixed rate deals, such as anything over a period of 5 years, some lenders will allow you to borrow more money on your mortgage. So if you are looking for a residential deal, it may be the difference between being able to afford the mortgage or not. When looking at a buy-to-let deal, the lenders also stress the mortgage differently when you are looking at a longer term fixed rate deal. So again, when the lender's looking at the rental income on a buy-to-let, they will normally allow you to borrow more money when you're looking at a 5-year fixed rate deal as opposed to something maybe on a 2-year fixed rate deal. So the next type of mortgage product is called a tracker deal. Now a tracker deal is a variable rate mortgage. It's really important to understand what a variable rate mortgage means. So a variable rate mortgage means that the payments can go up and also down based on market conditions. Therefore, if interest rates were to rise and your mortgage is variable, then your monthly payments will increase in line with those interest rates. It does also mean that you may benefit if interest rates were to reduce, because if interest rates reduced, then your monthly payment would also reduce in line with those interest rates too. So a tracker deal runs in line with the Bank of England base rate. So at this time, the current Bank of England base rate is 3%. And what that means is normally with a tracker deal is you pay a certain percentage above the Bank of England base rate. So it could be, for example, that you pay 0.5% above the Bank of England base rate. That means your mortgage interest rate would be set at 3.5%. Now, when the Bank of England meets, if interest rates were to change and they were to increase, let's say, for example, by 0.5%, the Bank of England base rate would then go to 3.5%, and if your tracker deal is 0.5% above that, then your interest rate would have changed from 3.5% to 4%, meaning that you would have an increase in your mortgage payments. When you're taking out a tracker deal or any variable rate deal, it's really important that you look at potential payments if interest rates were to rise. Let's say, for example, that when you're looking at your mortgage with the current rates and the monthly payment is £500 and you can only afford £500 per month, if interest rates were to rise and your monthly payment was to increase, you would then be paying more than what you can afford. So when you're looking at variable rate deals, it's important to factor in any future interest rate rises. And if you speak to your mortgage advisor, they should be able to provide you with illustrations based on those interest rate rises. Another benefit of tracker deals is the interest rates are generally set lower than a fixed rate deal. So whereas a fixed rate deal, for example, may be at 5%, you may be able to find tracker deals that maybe, for example, be at 4%. So when your mortgage starts, your monthly payments will be lower than if you went on to a fixed rate deal. The other benefit with tracker deals is most tracker deals don't come with any early repayment charges. So what that means is if you pay your mortgage off early, or if you want to move your mortgage to another lender, then you wouldn't have any penalties to pay to come out of that deal. That means that your deal is much more flexible and is easily changed. Also, if interest rates were to rise and you've got no early repayment charges and you want to move your mortgage onto a fixed rate deal, because there are no penalties involved with that type of mortgage, that's really easy to do. Most tracker deals track the Bank of England base rate for a period of 2 years. However, there are some lenders that will allow you to track deals for longer. So for example, there are a few lenders in the market that will allow a 5-year tracker deal. There are also some lenders that will allow a lifetime tracker deal. And what that basically means is that will track the Bank of England base rate for the lifetime of your mortgage. There are also tracker deals called cap and collar. So essentially, what a cap part of that deal is the maximum interest rate that would be charged. So let's say, for example, the interest rate on your mortgage started at 3.5% and the lender capped your interest rate at 5%. What that means is if interest rates were to increase, the absolute maximum interest that lender would be able to charge you would be at a rate of 5%. So even if rates went above that, and let's say, for example, went up to 6 or 7%, the maximum amount that you would pay on your mortgage would be the 5% cap. When it comes to collar, the collar part of the tracker deal is the minimum amount of interest that lender would charge you. So using the same example, let's say, for example, your mortgage started at 3% and the collar on that mortgage was 2%. If interest rates were to drop, the minimum interest that lender would charge you would be the 2%. So if interest rates did drop below that, you would still continue to pay 2%. The other part of the tracker deal is it does track the Bank of England base rate, as what we've earlier explained. That means the lender cannot change that deal at their own discretion. It will always track the Bank of England base rate. So the last mortgage product available is called the discounted variable rate. Again, as what it says in the title, that type of mortgage is variable. So very similar to the tracker deal, the interest rate on the mortgage can go up, but it can also go down. What that does also mean, again, is that you need to make sure that you do factor in any potential interest rate rises into your mortgage. So with the discounted variable rate, It's the lender that determines the rate on that mortgage. So every lender will have what's called a standard variable rate. And that is the standard rate that they will charge every single customer that's not on a specific deal. A discounted standard variable rate means that the lender applies a certain discount to that standard variable rate. So not every lender has the same standard variable rate. So you might find that one lender has a rate of 5%, another lender could have it at 6%. The lender is in complete control of what they charge. The discount is what the lender applies to the mortgage. So if the lender has a standard variable rate of 5% and they apply a 1% discount for 2 years, that means for the 2 years of your mortgage, you will always pay 1% lower than their standard variable rate. Again, the term of that particular deal can vary. So some lenders may apply the discount for a period of 2 years, whereas other lenders may be able to also offer you a period of 5 years. The other part of a discounted variable rate is that the lender, as mentioned before, is in complete control of that rate. So even if the Bank of England was to increase their own interest rate, that doesn't necessarily mean that that rate increase is reflected within the lender's standard variable rate. Therefore, if the Bank of England raise the rates, the lender doesn't need to do so, and that does happen in certain cases. However, that does also mean that if the Bank of England were not to increase rates, the lender could still increase theirs. So most discounted rates do come with a collar. So as we mentioned under the tracker deals, a collar is where the lender will not allow your mortgage to go below a certain percentage rate. That's to protect the lender, to make sure that they are at least earning some interest from your mortgage. So let's say, for example, if your mortgage was 2% below the lender's standard variable rate and the lender reduced their interest rate to be below 2%, that would mean then that you would be paying no interest on your mortgage. By the lender having a collar in there, it protects that lender and makes sure that they do at least earn some interest. Now, discounted variable rates are less common with the high street. So your typical banks, such as HSBC, Lloyds Banking Group, Santander, they don't typically offer discounted variable rates. Most discounted variable rates are offered normally by your building societies, as an example. This is another good reason to reach out to a mortgage broker, especially when that mortgage broker has access to a comprehensive range of lenders, because what they're able to do is they're able to look at all of the lenders and make sure that you are getting the best deal that's appropriate to your circumstances. So again, as with tracker deals, with some discounted variable rate mortgages, there are no early repayment charges. These are less frequent than tracker deals, because some lenders do apply those charges. So again, when you're looking to take out a mortgage on a discounted variable rate, it's really important that you understand what charges are related to that mortgage. And it's the mortgage broker's responsibility to make sure that you have all that information so that you're able to make an informed choice. So there we go. All the different mortgage types available when you're looking to take out a mortgage. So just to remind, those 3 different mortgage types are fixed rates, tracker mortgages, and discounted variable rates. So if you'd like to find out more information about the mortgage application process, please watch this video here.